Okay, now I'm continuing with chapter 3, the adjusting process, and I'm taking two problems to demonstrate how you do the journal entries for the adjusting process. Now, the first one is problem 3.1a in your book, and the problem reads as follows, as you can see on the right. On July 31st, 2014, the following data were accumulated uh, to assist the accountant in preparing the adjusting entries for Atrium Realty. The supplies account balance on July 31st is 6,880. The supplies on hand on July 31st was 2,200. That was the first one. And the second one is the unearned rent account balance on July 31st is 9,200, representing the receipt of an advance payment on July 1st of 4 months' rent from tenants. That's the second one. And the third one is wages accrued but not paid at July 31st, 1,850. And then next would be fees accrued but unbilled at July 31st are 11,700. And then depreciation of office equipment is 3,500. So that is those are the issues that we'll be handling, and let us take them one by one. First one, it says supplies account balance on July 31st is 6,880. The supplies on hand on July 31st are 2,000. 200. So now what you need to do is you need to find out the difference between the two. So the difference between the two will be considered as um, the supplies that have been used. So let's find out the difference between the two. The difference between the two would be, let's see, 6,880 minus 2,200 would be 4,680. And now the difference will be considered as supplies consumed, and that will be debited to supplies expense account. So let's see, supplies expense account, and then it will be credited to the supplies account. So that will be 4,680. So that is the first journal entry. The second journal entry, it says the unearned rent account balance on July 31st, 9,200, representing the receipt of an advance payment on July 1st of 4 months rent. So now what you have to do is you have to understand that 9,200 is for 4 months, and only 1 month rent has been earned. So that will be 9,200 divided by 4 will be 2,300. So the 2,300 will be transferred out of the unearned rent account. So therefore, we'll be debiting the unearned rent account. So let's find the unearned rent account, and then it will be credited to the rent revenue account, because that is the amount of revenue we have earned. So please understand, the whole of 9,200 was credited to unearned account. Now we are debiting 2,300, that's the 1/4 which has been earned. Next is wages has been accrued. So wages accrued is of course wages expense. So let's see wages expense, And accrued means you have not paid it, as I have been saying to you. So wages payable would be credited. The amount is going to be 1,850. So that will be 1,850 and 1,850. Okay, now next is fees accrued but unbilled at July 31st. So accrued means you have earned them. So you'll be crediting to fees earned. And since you have not received the money, that would be accounts receivable. So we'll be debiting accounts receivable, and fees earned would be credited with the amount of 11,700 and 11,700. Okay, that is how we'll handle that. And next is depreciation of office equipment. As soon as you see depreciation, you should always debit depreciation expense account. So depreciation expense would be debited, and accumulated depreciation would be credited whenever we charge depreciation. That is 3,500 and 3,500. So that is how you would handle that. And the next part of the question is briefly explain the difference between adjusting entries and entries that would be made to correct errors. So now you'll have to understand that adjusting entries are planned entries, and to update your books of accounts, so that would be the adjusting entries are planned, and of course the correcting entries are not planned but arise only when necessary to correct errors. So that would be how you will be handling that particular problem. Now let us go ahead and take the other one, that is the next one. That's going to be 3.1b. If you see here, there's a format, and the problem is right here. Now 3.1b. Now in 3.1b, what you are given is you are given a kind of a trial balance with figures, and then data needed for year-end adjustments are as follows. Number one is unbilled fees at August 31st is 9,150. So that is first thing. And the second is supplies on hand at August 31st is 675. And rent expired is 5,000. So that will be, and depreciation equipment for the year is 3,200. And then unearned fees at August 31st is 3,000. And wages accrued but not paid at August 31st is 3,100. So that will be how we'll be taking that problem. Now I think I have a wrong problem in this. Let us find out the right problem. Go to that problem and then see. This is 3.5a and 3, yes, 3.1b. So this is the problem that I was trying to show it to you. So let us just take that here. Okay, and the problem reads as follows. Okay, on May 31st, 2014, the following data were accumulated to assist the accountant in preparing the adjusting entries for Oceanside Realty. Fees accrued but unbilled at May 31st was 19,750. So whenever this fees is earned but not billed, you will be debiting accounts receivable. So we'll be debiting accounts receivable and crediting to the fees earned. So that would be 19,750 and 19,750. And then the next one is number B, the supplies account balance on May 31st was 12,300. The supplies on hand at May 31st was 4,150. So if you take the difference between the two amounts, that's going to be 12,300 minus 4,150. So that is the amount of supplies we have used. So whenever you use the supplies, it will be supply expense and of course credited to supplies account. So that would be 8,150 as well. And next one is wages accrued but not paid. So that's a wages payable account, and wages expense would be debited. And wages accrued means you have not paid that, so therefore but you have incurred it, so you'll have to recognize it as an expense, and since you have not paid it, it has to be treated as a liability. So that is how you will handle that. And let's see number D. It says the unearned rent account balance at May 31st is 9,000, representing the receipt of an advance on May 1st of 3 months. So this will be again 9,000 and 9,000 divided by 3 months rent has been earned, so that is why we'll be debiting the unearned rent, because we want to transfer that unearned rent to the rent revenue account. So this goes to the rent revenue account, and the amount is 3,000. So that's how you will handle that. And the next one is depreciation office equipment. As I've been saying, as soon as you see depreciation, it should be depreciation expense and credited to accumulated depreciation. The amount is 3,200 and 3,200. Okay, so that's how you will handle that part of the problem, that is problem 3.1b. So we have completed those two demonstration problems. Let's continue with the learning objective number 3 of the chapter. It deals with the summarization of the adjusting process. Now the first adjusting entry would be with regards to prepaid expenses. An example is supplies, prepaid insurance, or prepaid rent. um, Reason for adjustment is prepaid expenses, that is the asset, have been used or consumed in the business operation, so therefore I have to transfer from the asset account to the expense account. So since I'm reducing my asset, that's why I'm crediting it, and expense is debited because I am creating it. The examples are supply expense debit, supplies credit, insurance expense debit, and prepaid insurance would be credit. Now, in the financial statements, the impact of the adjusting entry, if it is omitted, would be, because there is no revenue involved, so there will be no effect on the revenues. Expenses, if you don't do it, if you don't debit the expenses, you won't count them, therefore it would be understated. And if you understate the expenses, you will be overstating the net income. And in the balance sheet, if you do not adjust these entries, then your asset would be overstated because you won't reduce the asset and it will remain as such. And therefore, the owner's equity will also be overstated simply because the net income was overstated. And you know that net income percolates down to the owner's equity account. Next adjustment we learned was the unearned revenues. Unearned revenues like magazine subscriptions received in advance, fees received in advance of services, or anything that has not been earned. When the cash is received before the services have been provided, it is recorded as a liability. And I had explained to you why we do that is because if you don't provide that service, you will have to return that money. So therefore, it will be considered as a liability until and unless you earn that. Some services have been provided to the customer before the end of accounting period. Then you'll have to take out the money from the liability and transfer to the revenue account. The example would be unearned rent account is debited and rent revenue is credited. Now, if you don't do that, what will happen? Of course, revenue, you will not have accounted for the revenue, so that would be understated. Since no expense are involved, no effect on expenses, net income will also be understated because the revenues have been understated. Net income is directly related to the revenues account and indirectly related to the expense account, or they have a opposite polarity with the expense. And the balance sheet assets, there are no effect because there is no asset account involved, but liability would have been overstated because you won't reduce that amount. And owner's equity, as I said to you, it is directly related to the net income. So therefore, since net income was understated, owner's equity will also be understated. Next is the accrued revenues. As I've been saying, accrued revenue means revenue that has been earned but not received in cash. So services performed but not billed, interest to be received are the examples. And then services have been provided to the customer but have not been billed or recorded. Interest has been earned but has not been received or recorded. So those are the kind of situations where we do this journal. When we do it, asset will be debit and revenue would be credit. Now, accounts receivable is asset account that is debited. Fees earned is a revenue account that would be credited when you have provided the services, earned the revenue, and not received in cash or not recorded at all. If you omit this accrued revenue, what will happen? The revenue will be understated and no effect on expenses because this journal does not involve any expenses. In the balance sheet, the asset account would be understated because you won't be debiting to the asset account. If you don't debit, then you'll be having less of the assets rather than what you're actually supposed to have. And owner's equity is directly related to the net income, therefore, it is going to be understated. Next one is the accrued expenses. Accrued expenses, again, as I've been saying to you, accrued means no cash has been paid or received. If it is revenue, you won't have received any cash for the revenue. If it is an expense, you won't have paid the expense. Wages and salaries incurred but not paid, interest incurred or but not paid. So those are the kind of examples. Expenses have been incurred but have not been paid or recorded, then hence we'll have to bring them into record. So the general entry would be expense will be debit and liability would be credit. For example, if wages of 250 were accrued, then this is the journal you would do: wages expense to wages payable. And the effect on the financial statements would be no revenues are involved, therefore revenue will be no effect. Expenses will be understated because if you don't debit that wages expense of 250, then of course you'll be understating the expenses, and if you understate the expenses, income will be overstated than what it is actually. And asset will not have any effect because there are no assets involved. Liability, yes, wages payable is a liability. If you don't do this journal, it will be understated. And net income and owner's equity are proportionally related, so therefore it's same as net income, overstatement of owner's equity. And the last adjustment is with regards to depreciation. Depreciation of equipment or buildings is an example, and the logic behind is fixed assets depreciated as they are used or consumed in the business operation. To do that, we'll be debiting expense account and crediting contra asset account, that's an accumulated depreciation account. Now, depreciation expense would be debit, accumulated depreciation would be credit, and in case of effect on the financial statements, income statement, the revenue will not be affected because this journal does not involve any revenue. Expenses would be understated because we won't be debiting depreciation expense if you don't do this journal, and therefore the net income will be overstated because if you don't charge the expense, of course, you will be showing higher amount of income. And in case of an asset, you won't do this journal. So if you don't do this journal, you won't be reducing the asset. Therefore, you would be overstating the asset. Owner's equity is directly related to net income. Therefore, it is going to be overstated. So that is how you would be doing uh, the adjustments. Now, this is the summary journal entries that we just did. And now I'm going to show it to you how you actually post in the ledger accounts. Ledger accounts, you can see adjustment. We write adjusting entries in the item. So this is where we will be using that item information in the ledger. We'll be writing adjusting, and then of course same procedure that you'll be following. Accumulated depreciation was credited right in the credit column and carry in the balance. Here also you can see accounts receivable was involved in the adjusting entry, and then we are writing adjusting in the item and then doing debit. And since it is a debit balance account, I'm increasing the balance. So this is how I will be doing the posting those journal entries into the ledger. The important point is the posting principle is same. If the account is debited, take it to the debit side and calculate the balance accordingly. If it is credited, take it to the credit side and calculate the balance accordingly. But you need to specify that this is part of the adjusting entry. So we'll have to write adjusting in the item column. So that's how you will be posting all the adjusting entries. Now, once you have posted the adjusting entries, you will be calculating a new balance. And based on the new balance, what we'll be doing is you will be preparing an adjusting trial balance. Now, the adjusted trial balance, the purpose of the adjusted trial balance is to verify the equality of the total debit and credit balance before the financial statements are prepared. uh, like in case of unadjusted trial balance, we also do that. So this is, so unadjusted trial balance is prepared before any adjustments are done. Adjusted trial balance is done after all the adjustments have been done. So that is, now this is the adjusted trial balance, and as you can see, the figures are marked in blue to depict that there have been changes in those balances, and therefore the total will also be impacted. So now what we are going to do is, please download chapter 3, classwork 3 from Blackboard, and we will be solving that problem together in the next